Yeah. Good afternoon. Good afternoon, everybody.
Good afternoon, Mike.
Thank you. Yeah, I'm doing really good. Good afternoon, everybody. Good afternoon, ladies and gentlemen. Welcome to the Arcadian Court in downtown Toronto. Welcome to the Empire Club of Canada. For those of you joining by webcast or podcast, welcome to the meeting. In today's world, it can be hard to differentiate from signal and noise. On the one hand, we have seen stock markets reaching new highs. Just yesterday, we saw the Nasdaq hit a new record. Yet, there are still signs of a recession, while unemployment is low and consumer confidence is inching back up. Also in the mix, the geopolitical landscape is as complicated as it has been in some time. As we've witnessed in just the last few days, we've ricocheted from talk of World War III to renewed commitments to peace and harmony. Closer to home, the USMCA remains unratified, and our energy sector out west has yet to get new access to Tidewater. Lucky for us today, we are welcoming a distinguished panel to help us look ahead to 2020 and to sort through it all. And I'd like to start by introducing David Wolf with Fidelity Investments. David was previously an advisor to the Governor of the Bank of Canada and brings 23 years of experience to bear on his perspective today. Please welcome David Wolf.
So thank you very much, Mike, for that introduction. Thank you, all of you, for being here. And thank you in particular to the Empire Club for the invitation to speak and share some of our thoughts on the year ahead. David just told me that he's got about 40 slides and I only have 6. So I'm going to run really fast and then hopefully give him the floor for the bulk of the time. So I wanted to start off, not so much with that one, so with a couple of quotes. Some of you may be familiar with these quotes. They've been attributed variously to Mark Twain. I've seen them attributed to Yogi Berra. Frankly, nobody is quite sure who said these first, and that uncertainty itself is a little bit of a theme that you'll see running through my remarks today. So the first quote is, "Making predictions is hard, especially about the future." Again, many of you have heard that before. But I can tell you, I've been a forecaster most of my career, as you heard from Mike. I spent many years on the sell side as a forecaster, spent many years at the Bank of Canada contributing to their forecasts, and now as part of my job as a fund manager. And I can attest to how difficult forecasting is. We all have to do it to some degree, but it's at best not that useful an exercise, and at worst actually pretty futile. The world is an uncertain place, we all know that, and no one's crystal ball, no matter what they tell you, is ever going to be particularly clear. Which leads to the second quote here, which is, "It ain't what you don't know that gets you in trouble, it's what you know for sure that just ain't so." And this one I think of as actually reflecting the core of our, or at least part of the core of our investment philosophy at Fidelity. So essentially what we're trying to do is take advantage of the fact that people always think they can forecast better than they actually can. So often markets get fixated on a certain prediction, a certain narrative, which then gets reflected in market pricing. So for us, rather than thinking that we can outpredict the market, which is a very difficult thing to do, if not impossible, what we're trying to do is look for opportunities where markets themselves get certain about something that they really have no business being so certain about, and we take the other side. And I wanted to offer today in my time 3 examples where that appears to be true at present, where we're putting capital behind our ideas, where people think they know what's going to happen, but I don't think they can really know the way they think they know. So the first one is markets seem to be convinced that the U.S. equity market is the place to be. It certainly has been the place to be for the last decade. You can see in the chart here, so the blue is the S&P 500, the green is the ACWI ex-US. If you invested in the US 10 years ago, you've made 250% total return. If you invested in the ACWI ex-US, you've made about 65%. Obviously a heck of a gap, and a lot of this has to do not only with the strength of the US economy, but also the kinds of companies that we find in the US, particularly the sort of growth-oriented technology companies like the FANG stocks that investors seem to be convinced are going to take over the world with valuations to match. By contrast, many stocks in other areas of the world are trading like, well, to be frank, a little bit like charity cases. But we do know that, now this may be right, this may be wrong. Again, theme is, I don't know. But I do know that these divergences like this between the US and other markets, between growth stocks and value stocks, which is actually almost the same thing at this point, have generally proved unsustainable in the past. And so, as I mentioned, we're taking the other side of this. We've been moving capital outside of the US to these more unloved areas of the world where there seems to be a lot more room for outperformance relative to expectations than in the more expensive US market where many companies seem to be, in a sense, priced for perfection. The second area where I think there's an opportunity is in inflation, and in particular the conviction in markets that inflation is gone for good. So this chart is looking at the spread between the yield on nominal bonds in Canada and real returns to inflation-adjusted bonds in Canada, which essentially is a good proxy for inflation expectations. And as you can see in the chart, those expectations are nowhere near the inflation rate that the Bank of Canada is actually mandated to deliver. Same story is true pretty much throughout the world, just about always and everywhere. People think inflation's been very low for a long time and it's going to stay that way if not dip into deflation. Again, don't know, could be right. But I think the risk is, and very much the side of the risk, is that the stubborn failure of inflation to rise over the past decade is actually what makes inflation more likely to emerge ahead. And the reason for that, and this kind of pains me to talk about as a former Bank of Canada official, to some degree this is an indictment of central banks and what they do. So central banks have thrown the kitchen sink at the economy, so negative interest rates, massive purchases of securities, et cetera, and they still haven't managed to hit their inflation targets. In the meantime, they've inflated asset markets and they've contributed to the greater inequality that in turn is fueling a lot of the more populist politics that we see around the world today. And so when you put it all together, the risk is at some point governments say, you central bankers, you're unelected bureaucrats, you've messed it up for everyone, you're all fired, we're taking monetary policy back ourselves. And when governments get their hands on the printing press, always and everywhere historically, that's led to higher inflation. So I don't know if that's going to happen, and if it does, I don't know when it's going to happen, but I think it's dangerous to dismiss the possibility. And so, again, we're taking the other side of this so-called deflation trade. We've been buying real return bonds, TIPS in the US, gold, and other commodities as well. The third opportunity that we're trying to take advantage of is sort of a sanguine view on Canada that seems to be reflected in markets. So this chart shows two-year government bond yields in Canada and other economies, and this really reflects both current and expectations of future short-term interest rates in the various economies. So the fact that Canada is the highest yielder is basically saying people view Canada as less in need of stimulus than just about any other economy in the world. Again, could be right, don't know, but I do think that there's a lot of risk to that view. And the risk comes from the fact that Canada's economy has been solely driven by consumer spending, by housing investment in recent years, and that's been funded by record levels of household debt, as everybody in this room knows, to the point where these sectors, so consumer spending, housing investment, actually comprise the largest share of GDP in our country than they have in more than half a century. At the same time, business capital spending and exports, which are more traditionally the productive drivers of our economy, have contributed exactly zero to growth over the past few years. And that doesn't look likely to change anytime soon, given the current backdrop. So this sort of profound economic imbalance hasn't proven sustainable anywhere else in the world where we've observed it, and I don't expect it to be sustainable here either. So I don't know when the chickens are going to come home to roost, so to speak, but I do know that markets are priced for very little risk of that happening. And so again, we're trying to take the other side of it. We've generally been avoiding assets that are levered to the Canadian consumer and the Canadian economy, and that includes the banks. I know a lot of your representatives, the banks, sorry about that. And avoiding the Canadian dollar as well in favor of more foreign currency exposure. Finally, to bookend my remarks, I wanted to offer one final quote. So this one is from a guy named Wee Willie Keeler, who was a baseball player in the late 19th century, although I guess I should say in the theme of my remarks, we think that's who said it. Actually, nobody can be sure. It was 150 years ago. But he got asked his advice about how to be a great hitter, and he responded with this quote, which is, "Hit 'em where they ain't." And obviously the notion is that if you hit the ball to where the fielders already are, you're not going to be particularly successful as a batter. So hopefully you can see the read across to what I've talked about today in terms of the investment approach. You've heard a lot of predictions, I'm sure, already about what's going to happen in 2020. You're going to hear some more today. Now, I don't say ignore them. In fact, they'll almost all be well-reasoned, well-argued, worth listening to, et cetera. But the fact of the matter is, from an investing point of view, the trouble is a lot of these, at least in aggregate, these kind of predictions are already priced into markets. And so given the uncertainty endemic to the world, it's actually the predictions that you don't hear at the beginning of the year that are probably going to be the ones to be most profitable. And that's really a cornerstone of the investment approach that we take for the funds that I'm responsible for at Fidelity. So just to conclude and to be very clear, I don't know what's going to happen in 2020. I don't think anybody else does either. And that's actually something that we're going to try to take advantage of, and we always try to take advantage of in managing the funds. Final point, if anyone does have an inkling of what's going to happen in 2020, it's almost certainly my good friend and former colleague, David Rosenberg. So I'm going to get off the stage and leave it to him and his several dozen slides to actually give you some forecasts. Thank you.
Yes, our next speaker is the Chief Economist and Strategist for Rosenberg Research and Associates. He has been celebrated for the accuracy of his economic predictions and forecasts. The Financial Post named him one of the top 5 most influential Canadians in investing. So please join me in welcoming David Rosenberg.
Thanks, and Happy New Year, everybody. You know, I keep getting the question, what's it like starting up your own company? And the answer hasn't changed. The boss is such a jerk. All right, so anyway, I agree with everything that Mr. Wolf said. If you don't know, we worked with each other at Merrill for many, many years back in the day. And that's why we have disclaimers and all these forecasts, but I'll do my best. Now, for those of you that have heard me speak the past couple of years, and heard the shtick, I realized a couple of years ago that you can actually forecast by relying on the Chinese zodiac. I'm not so sure that it's reliable, but I still use it. So for those of you that were here 2018, if you remember, it was the Chinese year of the dog. And the dog was Jay Powell, chairman of the Fed. And the tagline was, will the dog bark? Will the dog bite? And he barked, and he bit, and then he whimpered under Donald Trump's tweets. And then last year, for those who was here last year, by the way, show of hands. Do you remember what I said? I love people with short memories. That's the key to longevity in the forecasting business. So last year was the year of the pig, which is completely ironic since a third of the pig population got wiped out in China. And the tagline was, can we paint lipstick on this pig? And surely the world central bankers, led by the Powell pivot, certainly did that job, and the primary reason why we're in this liquidity-driven, I would say, bubble right now. So this year is the year of the rat, and I'll play my Jimmy Cagney routine, you dirty little rat. and say that I do smell a rat. And when I say a rat, I mean that as somebody who focuses on the economic fundamentals, I have never seen a divide this wide. Gesundheit, a lot of people are allergic to this forecast, I understand that. I've never seen a divide this wide between what's happening in the financial economy and what's really happening on the real side of the economy. So December 24th, day before Christmas, the Wall Street Journal comes out with markets rally like it's the 80s. And I'm going to come back to that towards the end of the presentation. But I don't know if this is just a classic case of cognitive dissonance or it's exactly what I'm talking about, that 2 days later, on Boxing Day, or what we call Boxing Day, same newspaper, recession tops list of US CEO fears. Right after, 48 hours after, that we're told that we've got a rally like it's the 1980s, which is actually, between Reagan and Volcker, a real pure earnings-driven cycle. So I look at what's happening in the past year as a spectator in the front row, and I marvel at it. This was first quarter earnings, and this is the steady deterioration in the consensus forecast starting July of 18. Let's go back a year ago. Let's go back December 18. Consensus was 3.5% on first quarter earnings. This is first quarter of last year. We ended up with negative 0.3. You go to second quarter. December was 4.1. Ended up with negative 0.4. Go to third quarter. December, 4.6. Ended up negative 2.2. Do you see where I'm going with this? And then everybody right now is talking about fourth quarter earnings that are going to come out in the next couple of months. December of last year, when the trapdoor opened up underneath the marketplace, the credit markets froze, everybody is hiding under the desk screaming uncle, the stock market's down 20%, God forbid, the consensus was 11.8% on earnings. And here the markets ripped 30%, and what do you know, we're negative 1.4. We had 4 quarters in a row. Now it's true, we did not have a GDP recession, but for an equity investor, why do you care? When 20% of that GDP is government. You're not buying government. There's no GOV as a ticker in the S&P 500. We are in a 4-quarter earnings recession, and the stock market absolutely rips 30%, which, by the way, only happens in the past in the context of coming out of recession, and here we are more than 10 years into this expansion. This is rather incredible. But when you look at price to sales, or EV to EBITDA, or price to book, I just put up one of these price to sales, we have the most expensive. Now, maybe people want to say, well, interest rates are so low. I live in a world of TINA. There's no alternative, or FOMO, fear of missing out. But the reality is that if you're buying the art at the auction at Sotheby's, you know that this stuff has really gotten to nosebleed territories to the point where valuations, insofar as they still matter, are the highest they've been since the dot-com bubble 2 decades ago. So, David Wolf talked about, do we trust the economists, or do we believe the economists? And I would say it's not a question about trusting the economists. This was in the New York Times a couple of months ago in November. I guess from your perspective, do you want to listen to economists? Or certainly when it comes to the stock market, do you want to listen to economists today? When we have this cycle, the grand total of a 7% correlation. That's what economists do for fun. We run correlations because it's about relationships. 7% correlation between the S&P or the SPX and GDP. We've never seen that before. Over a whole cycle, never seen that before. You see, historically, it could be as low as 30 or as high as 70. It's never 7, it's never 100. There's a whole bunch of things you have to take into account when you're talking about the equity market. Sentiment over here, valuations over there, technicals, market positioning, fund flows. Never before has the correlation with the economy been so weak. And of course, it goes to reason that everything last year was a 4-point multiple expansion in the context of a booming equity market and a 4-quarter earnings recession. So let's try and get ahead of this and find out what's really going on here. And what's going on is this renewed balance sheet expansion by the Fed. Everybody talks about, and I said earlier, the Fed, the Powell pivot, the Fed cut rates 3 times. This is even more powerful. Don't you see how the Fed has taken sour milk and turned it into a milkshake? Because we had this crazy thing happen in the repo market. The Fed lost control of the overnight rate. And to get ahead of it, they've got this temporary fix, which is they are hoovering up $60 billion of Treasury bills every single month, which is how the yield curve is re-steepened magically. But it's done something else. Let's take a look at this. You had QE1, QE2, QE3, a period where there was not much going on with the Fed balance sheet. And then, starting in October, the beginning of October, the Fed started what they don't call QE4, but it is QE4. And so far, it's been more than a $300 billion expansion of the Fed's balance sheet. Do you know that Jay Powell, and that's why he hasn't faced a tweet from Donald Trump, is the Fed is now financing more than 100% of the U.S. fiscal deficit. Normally, that's what an emerging market does. And leads me to believe as to what the future is for the U.S. dollar as a reserve currency, although right now there's nothing to replace it. But let's just take a look at the 12-month return of the stock market. 12-month return for all the people saying, wow, what a great year for the market. Your great year for the market was 3 months. Maybe you could say, well, 2018, the bad year for the market was also 3 months, but that was all you got last year because by October the 8th, and October the 8th is a critical date because that's the date that the Fed issued its memorandum that we are going to start to buy Treasury bills en masse to try and paper over these liquidity and collateral problems in the repo market. So look for yourself. There's the evidence. The 12-month trailing total return in the U.S. stock market in early October was a grand total of 1%. And we finished the year magically up 30%. You know why? Because historically, going back before 2009, there was no correlation, zero, between the Fed's balance sheet and the stock market. That all changed with Bernanke. And through the cycle, QE1, QE2, QE3, the correlation between the stock market and the Fed's balance sheet went to 70%. 70. With the economy at 7, with the Fed's balance sheet at 70, and since the beginning of October, that correlation has ballooned to 95%. So that's your story, liquidity. M2 growth is running at a 12% annual rate. And the only reason it's not causing inflation is because velocity of money is turning lower. And that's why you're not getting the inflation in the real economy, but you're getting the inflation in financial assets. And this is actually the best symmetry of all. It's what I call the bull market has really been a financial engineering. This has been the biggest debt for equity swap of all time. This whole cycle, the past 10 years. Think of the perfect symmetry. $4 trillion of quantitative easing. The Fed bringing all these safe assets, high-grade mortgages and treasuries on the balance sheet, creating all this vacuum and room. Oh, for what? For corporate treasurers to come in and flood the market with debt. Think how perfect. $4 trillion of QE, $4 trillion of corporate bond issuance to do what? To buy $4 trillion of equity, buy their shares back. People always ask me, who's buying stocks? Who's buying stocks? Well, companies are hoovering up their stocks to the point where the share count of the S&P 500 is down to its lowest level in 20 years. It's like the stock market. It's like a copper mine that got shut down. It's trading like a commodity. But this is exactly what's happening. You know, when I went to school, Economics 101, I know when David Wolf and I went to school, you learned, well, corporate treasurers will issue a bond to do what with it? To embark on capital spending. No, not this cycle. This was the weakest capital spending cycle of all time, globally, and in the US and in Canada. No capital deepening. No, where did the corporate bond money go to was to buy back equities. But you're left with this balance sheet. If I was here in 2006 and 2007, I would show you the mortgage debt to GDP ratio, and I would say we are in a huge mortgage bubble here. People would roll their eyes. And I talk about the same thing today. Look at the corporate debt on the balance sheet. I could net cash out of here if you want me to. People talk about cash. Yeah, there's 3 or 4 companies that have all the cash in the United States. Debt to GDP in the corporate sector is a huge bubble. And actually, that chart, by the way, looks worse in Canada than it does in the United States. We always talk about the consumer bubble here. And it's on the Fed's radar screen, right? This is in the Financial Stability Report in the last year. And they talk about how widespread downgrades of bonds to speculative grade ratings could lead investors to sell the downgraded bonds rapidly. Increasing market liquidity and downward price pressures in a segment of the corporate bond market known already to exhibit relatively low liquidity. By the way, keep that in mind, liquidity. Liquidity this year is going to be very key. So I'd say right now, I talked before about price to sales, price to equity, price to book. I'd say actually that the corporate bond market is more mispriced against the prospect of a default cycle than the equity market is mispriced against earnings. So here we have the most leveraged corporate bond market of all time, and high yield spreads are 200 basis points below the long run mean. Something doesn't add up here. I smell a rat. So this is definitely a place that you want to avoid for the next 12 months, is leveraged spread product, and you want to avoid the high yield area of the marketplace. Now what about treasuries? It's funny, treasury yields surprised. Nobody talks about the treasury market, and I haven't until right now as well. that all we talked about was, wow, what a stock market last year. But you know, the consensus on the 10-year note this time last year, the consensus was that as of today, the 10-year note was going to be 3.25%. Well, as I came here today, it was 1.9. So one of the big surprises last year was 10 and 30-year bond yields melting, and not just here, and not just in the US, but globally. And here's what I love as an economist, was when the Financial Times says bonds are a more reliable guide to the future than the equity market. So once again, got to figure out, what are the correlations? What are the correlations that drive long-term interest rates? Fed funds rate, so you got to get monetary policy right, and core inflation, not total core inflation. So we got to get the Fed right, we got to get inflation right. Well, let's start with inflation. So this chart, and this is a real economic nerdsy chart, but it might be the most important chart in the whole presentation, and it is something called the output gap. Anybody know what the output gap is? Okay, there's no economists in the room, that's a good thing. Look, one of the first things they teach you in school is about these two powerful curves called supply and demand. What else do you want to talk to an economist for? I mean, we're a bunch of fun-loving people, I understand that, but if you don't have, people say, like, no matter what, whatever you're calling, if you're calling the price of anything, I don't care if it's copper, I don't care if it's crude, I don't care if it's corn, I don't care if it's real estate, you can have your price forecast, but I might come back and say, well, show me your supply-demand curves, okay? Now, I'm not going to be that rude, but if you have a price view, well, the price is just the interaction of supply and demand. So I'm thinking about these things all the time, which shows you how fun and exciting I am. And we're talking here about two powerful curves globally, aggregate supply, aggregate demand, and the shape and how they're moving over time. And this is what I think about all the time because inflation is so key and so is deflation. I take the other side of David's bet on inflation. I think we're heading into a deflationary environment, and we've really been in one for some time. Below the zero line, the output gap is in a deflationary situation in the sense that aggregate supply is greater than aggregate demand. Above the zero line, you're in inflation where aggregate demand is running faster than aggregate supply. For the first time in post-World War II history, despite the 10 years of growth in the global economy, this gap never closed. The gap never closed this cycle. That is key. And we know that that gap, the deflationary gap, is going to widen. How do we know? Because the OECD leading indicator, which is down 21 of the past 22 months at its lowest level in over a decade, is telling you, sorry, there ain't no global growth reacceleration this year. So that means that deflationary output gap, those supply-demand curves, are going to be moving in a deflationary direction, and you're seeing it in something called the data. Producer prices are deflating outside the US, and now they're rapidly disinflating inside the US. And I come to this chart here, and it absolutely blows me away. These are the cyclical peaks in core inflation in the United States. We peaked this cycle at 2.4%. That was the peak. Back when I was at Merrill, back in 06-07, I was saying when we peaked at 2.9, it was the lowest peak since the 1950s, when we were watching Leave It to Beaver and the Hillbillies. But now I can say the peak at 2.4 is the lowest cyclical peak of core inflation since the 1930s. That doesn't freak anybody in the room out, seriously. 7 years of free money, repeated rounds of quantitative easing. Let's see. Massive fiscal deficits, and for good measure, cost push from tariffs. And as Billy Joel would say, that's all you get for your money. It's 2.4. And where are we going from here? Well, the leading indicator from the New York Fed, they do the work for you already. The New York Fed's leading inflation index has already peaked in July of 2018. It's rolling over. So my view is that inflation is going to be melting in the next 12 months. Now, can the Fed stave off the recession? The big question. This was actually in April of 2001. Same question. The venerable economist asked the question. Greenspan to the rescue. Same thing. He had already cut rates 150 basis points, not 75 like the current Fed. And everybody thought, we got to get a jail out of free card, whatever it's called, out of Monopoly. You know what I'm saying? Get out of jail free card. Who knew, and Greenspan didn't know, that the recession actually started the month before? Who knew? It's like, the recession. I don't see the recession. Dave, I don't see the recession. It's like, I don't smell the carbon monoxide, do you? I really don't smell it. So what you have to know is that the recessions follow the peak in interest rates, and there's a lag. And you could see that the New York Fed's recession probability model you can't take it away, hit 80% last summer, and it leads by 12 to 18 months, which tells me second half of this year, this expansion has the bullseye on its forehead. Now people say, oh, well, the recession risk is down below 50. Yeah, it always goes below 50 after the Fed cuts the rates, and that'll paint the brighter picture for 2021. If I get invited back, I'll have a much more bullish view, but you can't take that away. So in terms of back to interest rates, if we get this recession, which I think we're going to, get a profits recession, I think it'll morph into a GDP recession. Historically, the Fed cuts rates almost 500 basis points. And their starting point was, what? Their starting point was basically 2.5. So they might have to go to negative rates. They'll certainly go to zero. And the Fed is doing a lot of work on negative rates right now behind the scenes, that Europe might come here. So my major point here, I can call it the year of the rat, maybe to be more benevolent, I'll call it bonds have more fun. Steve Poloz, if you remember, was here December the 12th, and he gave one of the best speeches of all time, and it stood the test of time. This was basically more than 3 years ago in his famous Living with Lower for Longer speech, where he said some of the forces leading to low interest rates will persist for a long time, so we need to prepare for lower for longer. Individuals need to plan for retirement with different assumptions about longevity, interest rates, and growth, and that is as true today as it was then. Now, this is a tough table to digest, but I just want to show you what I box here. Aggregate supply, aggregate demand, two different measures of GDP. You'll see for yourself when they talked about partying like the 1980s in the Wall Street Journal, give me a break. Whether you look at the supply side of the economy, the demand side of the economy is growing 4% per year. We're barely growing 2% per year right now because we have too much debt. We didn't have any capital deeping, so it's impaired productivity, and we have aging demographics. So as you saw in that table, which I just took away from you, the peak in growth is getting lower and lower and lower over time for these three things. Impaired productivity because of no capital deepening. The bull market, unfortunately, was in financial engineering, aging demographics, and excessive debts. So this chart does not lie, right? The old saying about lies, damn lies, and statistics, that came from Mark Twain. The peaks in long bond yields are getting lower, the troughs are getting lower, because the peak in GDP growth is getting lower, and so are the lows. And this process is not ended. So it might be true that I'm not bullish on stocks, and maybe I should have been, but I've been bullish on bonds. And the long bond, by the way, you should know this, made you almost a 20% return last year with a third of the volatility that the stock market has. And if my forecast is right on what the Fed's going to do, what inflation is going to do, the two primary drivers of long-term interest rates, this is going to be a primary focus for me in terms of how I'm investing in the next 12 months. Thank you very much.
You have 6 months to get firewood and bottled water for your home. Our third and final guest today has spent 20 years developing a deep knowledge of all things gold, silver, and platinum. Nick Barisheff is the president and CEO of BMG Group, an author and media personality. We are thrilled he's able to join us here today. Please join me in welcoming Nick to the stage.
Thank you. Good afternoon. It's a pleasure to speak at the Empire Club again. First time I spoke at the Empire Club was in 2005, to show how old I am. I said then that it wouldn't matter to bullion investors if the gold price ended up the year at $400 an ounce or $500 an ounce, based on what the long-term trend is going to be. Well, gold ended up the year at $513. In 2019, gold had a good year. It was about 18%. But what surprises many is that since 2000, gold has averaged 11% across all currencies. 11%. 9.7% in the US and 8.8% in Canada. Now, according to the OECD, the average 15-year pension return is 6.6% in Canada and 2.6% in the US. Now, you don't need to be a mathematician or need a complicated algorithm or a computer to conclude that if you add gold to a portfolio, it'll reduce volatility and improve returns. Most pension funds, there's only 3 that I can think of that have any gold in the pension portfolio. globally, 3 pension funds. And other than the big ones, none have real estate, but none invest in real estate investment trusts. If you look at the comparison, you can see in this chart the returns of gold bullion versus pension fund returns. Now today, investors are euphoric with financial markets and they're setting new highs every day, but they're highly overvalued by every conventional measure. So this year I promise my standard offering of doom and gloom, but I'm also going to present a contrarian strategy for protecting and even profiting during the inevitable market correction. This is the first time in the 40 years that I've been in the business that we have a simultaneous bubble in equities, bonds, and stock, and in real estate. Simultaneous. In all the other cases, it's been one at a time, not all 3 at the same time. And there's a direct correlation, with the amount of liquidity that central banks are injecting and the inflated asset prices. Now, according to David Stockman, he says we have the greatest mother of all bubbles, and there's nobody left in the stock market today other than drugged up day traders and robots who are being mainlined by the daily injections of liquidity from the Fed. This is utterly irrational. This is kind of a big picture overview. First we had a tech bubble and a housing bubble, and today we have a triple bubble. Many economists and financial analysts believe that the next correction will be worse than 2008. Some think it'll be worse than 1929. Just to put it into perspective, in 2008, the total U.S. federal debt was $8 trillion. Today, it's $23 trillion. In 1929, it was only $17 billion. The 2008 crisis was precipitated by a Lehman collapse, but today the Deutsche Bank would be 10 times that size. Deutsche Bank has $48 trillion in derivatives. It's one of the largest derivatives books in the world. And to make matters worse, margin debt has increased by 223% since 2008. So in a correction, margin calls will precipitate the decline to be a much faster decline. According to Case-Shiller, U.S. real estate prices are once again at the highs reached in 2007. There's over $12 trillion of negative yielding sovereign debt. And the U.S. equities have been in the longest running bull market in history and have increased by 480% since the 2008 crisis. In both real estate and equities, individual and corporate earnings have been in decline, but prices for both real estate and equities have risen. So a 50,000-foot overview of this chart going back to 1929 is what this looks like. So you can see we have the second highest ever equity market running the longest ever. Sooner or later, there's going to be a correction. If we correct down to the bear market average, that's 37%, and if we overshoot it, it's at least 46%. 46% decline. Most cases, when you have an overshoot to the downside, it will overshoot the conventional averages, so it should be much worse. Now, the 2008 crisis was caused by largely $1.2 trillion of subprime mortgage debt. Well, today the student loan debt is $1.6 trillion. Global pension funds are underfunded by $78 trillion in unfunded liabilities. This is during the biggest bull market in history, underfunded by $78 trillion. That's not an amount that the central banks of the world can easily print. Of the S&P 500, 25 of the largest companies have pension liabilities of $151 billion. And in the US, if you combine the public pensions and Medicare, they're underfunded by $120 trillion. That's $367,000 a person. In Canada, public sector unfunded liabilities are $2.2 trillion, or $243,000 per person. Companies listed on the TSX have $100 million in unfunded liabilities. So since these liabilities were incurred during the largest bull market in history, it is likely that during the next correction, the losses in pension assets are going to become unfunded liabilities. Now, the pension problem isn't an academic exercise or a theory. In California, a number of the municipalities managed by CalPERS have already sent out notices to the retired teachers, firemen, and policemen that, so sorry, but from now on, your pension checks are going to be cut by 50%. In the US, the Pension Benefits Guaranty Corporation is projected to collapse by 2025. If it does, it would leave retirees with 2% of what they expect. Now, the riots have already started. Paris, Chile, these riots took place simply because logical pension reforms were suggested. We have riots for that. Since most pension funds, other than the very big ones, only hold stocks and bonds, there will be class action lawsuits when pensioners don't receive their promised pensions. It always happens. The lawyers clean up. There'll be absolutely no justification why CEOs, plan administrators, and portfolio managers fail to diversify their portfolios. There's 7 asset classes, not 2. There is no excuse for eliminating the best performing asset classes. Now, in this chart, I have 5 asset classes. I've left out commodities and collectibles since there's no convenient way to deal with them. But surprisingly, real estate investment trusts have been the best performing asset class the most frequently, gold the second, followed by stocks, bonds, and cash. Other than what's best performing, what this chart tells you right away is the importance of diversification, because they keep changing, like it's a moving target. So the plan is to diversify, but yet nobody does. In the future, it'll only take a small percentage of the $350 trillion in financial assets to reallocate to gold to cause an exponential price spike. Mine production and new discoveries are in decline, and central banks are setting records in gold purchases. There is only about 1.9 trillion of above-ground bullion available. This doesn't count the jewelry, the central bank holdings, and so on. And since most of this is already held by the world's wealthiest families, it's unlikely that it would come onto the market at any price. The bottom line is, unlike paper assets, which can be created without limit, gold supply is known, it's limited, and can only increase with actual mining. When it becomes obvious to market participants that the next correction is upon us, it will become difficult for pension funds to achieve a meaningful allocation without driving the price to multiples of today's price. Now, this quote is one from Ray Dalio, who runs the largest hedge fund in the world. And he says that in his roughly 50 years of being a global macro investor, he's observed that there to be relatively long periods, about 10 years, in which the market and market relationships operate in a certain way, which he calls paradigms. Most people adapt to and eventually extrapolate so they become overdone, which leads to shifts to new paradigms in which the markets operate more opposite than similar to how they operated during the prior paradigm. So one of the things I promised to say, okay, well, that's enough of the doom and gloom. What do you do about this? So we've been studying this situation for a few years, and one of the conclusions we come to is the conventional wisdom of always staying invested doesn't work. It doesn't work when you're at the end of the current paradigm. This chart shows that if you held your position in 1929, it took you 67 years to break even on an inflation-adjusted basis. Now, clearly, most people weren't alive by then to break even. The 1999 high-tech bubble didn't correct till 2018 on an inflation-adjusted basis. Again, a long time to wait. This is where gold comes in. Now, normally, a 20% allocation of gold will improve returns and reduce volatility. But during market corrections, you get a dramatic input. These are all the S&P 500 declines. And you can see the rise in the gold price is almost diametrically opposite. It's during these declines that gold transfers wealth. So we have to ask ourselves now, how close to the edge of the cliff do you want to go? So do you think that the next 10 years will be like the last 10 years, and the S&P 500 will go up another 480% to 37,000? Or are you going to have a retracement back to 3,200? Historically, great fortunes have been made by those confident enough to exit the markets before the downturn and park their money in real assets such as gold. Then you re-enter the market at significant discount when the correction is finished. Central banks have been setting records buying gold, and many ultra-high net worth investors have already allocated to real assets and gold. In the current bubble, we have looked at this and modeled a strategy that uses an initial tactical allocation of 100% to gold. A lot of people find that amazing. But when you consider it, is that when the inevitable correction completes, you've made money in gold and everything else has lost 50 to 70% of its value. It's then that the bargains rise. We've back-tested this strategy as applied to the 2008 crash using actual performance data. The model we got generated 25% a year returns. Now we've created a hedge fund that follows this strategy. So in conclusion, I encourage everyone to take a hard look at this and do some serious soul-searching on this issue. It requires foresight, independent thought, and immense courage to swim against the tide of popular thought. But the rewards of preserving and possibly greatly enhancing your family's wealth for generations will be worth it. So in 2020, I think it also won't matter if gold ends the year at 1,500 or 1,900. As I have set out in my book, it'll go much higher in the future. Thank you.
I am pleased to welcome Richard Carleton from the Canadian Securities Exchange to offer appreciation.
Thank you very much, Mike. I have the enviable task of thanking our speakers today. I guess, anybody? But first off, I wanted to, in particular, welcome the guests of the Canadian Securities Exchange, 2 tables here. A lot of them actually are traders, and I can assure you that they're not liquidity-fueled robots, which I guess means they're the other kind, but in any event, I did enjoy that quote immensely, Nick. And the other thing is I've got to have a shout out for the crack team of talent scouts at the Empire Club because, you know, we know what we're going to get from Nick. We know what we're going to get from Mr. Rosenberg. And I thought we were going to perhaps change the conversation a little bit with David Wolf from Fidelity, but no, I'm afraid, in fact, this year the most optimistic forecast we heard was from David Rosenberg, who actually gave us a trading idea that is pretty much guaranteed to be a winner this year, which is, of course, long-term U.S. debt, I think was. So, as I say, and just to prove that I was paying attention last year, I believe the conclusion was there isn't enough lipstick to put on this pig. And there was a shout-out for Japanese equities, I think, somewhere along the line. And I immediately went away and tried to trade Japanese equities and found it was hellaciously difficult as an individual investor to do that. But notwithstanding that fact, I obviously had to buy the Japan Fidelity Fund to get access to that market, I guess. But and thanks for that, Ted, by the way. In any event, again, this is really one of my favorite days of the year. The best thing about the markets is it's a daily conflict of ideas. And to be able to spend time with some of the smartest people in the markets, in the room here today, to exchange ideas, to challenge each other on a daily basis, on a macro level, on a micro level, is really the thing that gets us up out of bed in the morning to learn new things and to have our views challenged and to learn new things. And again, David, and Nick, a real pleasure. Thanks for your time. And again, I look forward to next year, maybe, as long as I've bought gold bullion, buried it in my backyard, along with some paper treasury certificates, and I'm not actually sure what you told me to do, David Wolf, but but in any event, I'll be talking to Ted George from Fidelity here about expanding my Japanese portfolio, I guess. I don't know. Thank you, gentlemen. It's been a real pleasure. And again, for all of you who are joining us here today, again, thank you. We know that your time is valuable, and we really appreciate at the Empire Club you taking time out of your busy schedules to join us on this important event. Thank you very kindly.
Wonderful. In closing, I'll just tell you that on January 14th, we have Anil Arora from Statistics Canada. He's their chief statistician coming. And on January 15th, we have a day of politics. We have the Honourable Monty McNaughton, the Minister of Labour, Training and Skills from the Ontario government coming. And in the evening, there will be the Ontario Liberal candidates seeking leadership of that party for an Empire Nights event. Please check it out on the website. Thank you. This meeting is adjourned.